Okay, so you've sent over this really interesting batch of articles all centered around evaluating commercial real estate deals.
Yeah, there's quite a mix in there.
Definitely some broad overviews of the main financial metrics, some, deeper dives into specific KPIs and profitability stuff. It looks like a good collection.
Absolutely. And what really jumps out is how often the same metrics pop up across the board.
Right.
It really hammers home which ones are fundamental when you're trying to size up a potential CRE investment.
Exactly. And I know what you're looking for is clarity, right? To cut through all the jargon and really get a handle on what actually matters for value and risk when you're thinking about investing in commercial property.
That's the goal.
So yeah, our mission today is to take these sources, pull out those key metrics, and really unpack them. We want to give you that practical knowledge so you can look at deals more confidently and hopefully avoid some common mistakes.
Sounds good. Where should we start?
Okay, let's dive in. When we talk about a property's basic performance, profitability seems like the obvious place to begin.
It is, yeah. I mean, fundamentally, any CRE investment boils down to its ability to make money. And the cornerstone metric for that is the net operating income, or
Oh,
NOI.
SOI, right?
Think of it as the property's paycheck. It's raw earning power. You figure it out by taking all the income it generates, mostly rent, obviously,
Okay.
and then subtracting all the necessary operating costs. So things like property taxes, insurance, maintenance, utilities, that sort of stuff.
Okay.
What's crucial, though, is that NOI doesn't include your loan payments, principal and interest, or big capital expenditures like a new roof or something.
Ah, okay. So it's purely operational income minus operational costs, like the property's own little business performance.
Exactly. It shows how well the property itself functions as a business before financing comes into the picture. Oh, and looking at NOI trends over time, that can tell you a lot more than just a single snapshot. It might reveal, how good management is or flag potential problems down the line.
That makes sense. Almost like taking the pulse of its financial health over time.
You got it. It gives you that clean apples to apples comparison between different properties. Now, once you've got the NOI, a really common next step is calculating the capitalization rate, the cap rate.
Right, the cap rate. Hear that one constantly. What does it actually tell you in simple terms?
So the cap rate, it's basically an estimate of the potential rate of return you'd get if you bought the place outright with all cash.
Okay.
You calculate it by dividing the net operating income, that NOI we just talked about,
Mm-hmm.
by the property's current market value, or what you paid for it. It's a super useful shorthand for quickly comparing different deals in the same market.
So it lets you compare, say, a potentially higher return property that might be a bit riskier against a steadier, maybe lower return one, puts them on the same page.
Precisely. And here's a key thing. The cap rate also hints at the market's perception of risk for that property type in that location.
How so?
Generally speaking, a higher cap rate might suggest a higher potential return, but it often signals higher risk too.
Ah, okay.
Maybe it's in a less stable area, or it has tenants with shaky credit or shorter leases. This added risk gets reflected in that higher cap rate figure. Conversely, a lower cap rate usually points to lower perceived risk, more stability, but potentially lower returns.
So there's like an inverse relationship there. Higher cap rate, maybe higher risk, lower cap rate, maybe lower risk.
Exactly that. You
Yeah.
really need to grasp that inverse relationship.
Okay, that clicks. So like a shiny new apartment block in a really hot downtown area might have a low cap rate because investors see it as super safe and reliable, even if the yearly return isn't astronomical.
Spot on. Now, another metric mentioned in one of your sources for a really quick initial look is the gross rent multiplier, or GRM.
GRM, how does that fit in? Is it similar to cap rate?
It's actually even simpler, maybe too simple sometimes. You get the GRM by dividing the property's price or market value by its total gross annual rent before any expenses.
Oh, okay. Gross rent.
Yeah. It gives you a rough idea of how many years of gross rent it would theoretically take to pay back the purchase price. It's really just a very preliminary filter, though. You never want to base a major decision just on the GRM.
So a property with a lower GRM might seem better initially because you're paying less per dollar of gross rent.
Usually, yes, it suggests a lower price relative to the raw rental income. But, and this is the big but, it totally ignores all operating expenses.
Ah, that's a huge blind spot.
It really is.
Yeah.
So GRM is best used as just a quick first pass. Maybe if you're sorting through a whole bunch of listings, don't lean on it too heavily.
Okay, so NOI and cap rate give us the real picture on profitability and value. GRM is just a quick glance.
Okay.
So Thinking as an investor, what I really care about is the return on my cash, right? The money I actually put in, that's where things like cash on cash return come in.
Exactly. So we've looked at the property's own profitability with NOI and cap rate. Now let's shift focus to your return on your specific investment. And yeah, cash and cash return is super practical for that.
How does it work?
It measures the annual cash flow you receive after paying all the operating expenses and your mortgage payments compared to the actual amount of cash equity you initially invested.
Okay, so say I put down $100,000 cash for a property, and after all the bills and the mortgage payment, I have $10,000 left over at the end of the year. My cash on cash return is 10%.
Exactly. Simple as that. It tells you directly how hard your initial cash investment is working for you each year. Very straightforward.
Okay, that's clear. What about equity multiple? That sounds a bit different.
It takes a longer view.
Hmm.
The equity multiple looks at the total cash return on your investment over the entire time you own the property.
The whole life
A
cycle.
whole life cycle. You calculate it by adding up all the cash distributions you get while you hold it, plus the profit you make when you eventually sell it, and then dividing that total by your initial cash investment.
So if I put in $100 and over, say, 5 years, I get back $200K in total cash flow plus sale profit.
Your equity multiple is 2x. You doubled your initial investment.
And
The thing to remember with equity multiple, though, is it doesn't factor in when you get those returns. A dollar today is worth more than a dollar in 5 years, right?
Right, the time value of money.
Precisely.
Yeah.
And that's where the IRR, the internal rate of return, comes into play.
Ah, yes, the IRR. That's the more complex one that accounts for timing.
That's one.
Yeah.
IRR is definitely more sophisticated. It explicitly considers the time value of money. It analyzes all the cash flows, inflows and outflows, positive and negative over the entire investment period, from your initial down payment right through to the final sale proceeds.
And what does it tell you?
It essentially calculates the effective annualized rate of return you're projected to earn on your invested capital throughout the whole holding period. It lets you compare investments with different time horizons and cash flow patterns much more effectively.
So I could use IRR to compare, say, a 5-year CRE deal against a 10-year one, or even against something totally different, like investing in stocks.
Exactly. It helps standardize the comparison across different types of investments. Now, one thing to be careful with IRR is that it relies heavily on your assumptions about future cash flows and, crucially, the final sale price.
Right, those are just projections.
They are. So doing a sensitivity analysis like what if rents don't grow as fast or what if the exit cap rate is higher is really important when you're looking at IRR figures.
Good point. Now, you also mentioned something called yield on cost, especially for development.
Yeah, yield on cost is tailored for development projects or major renovations.
How's that different?
It focuses specifically on the potential return based on the total cost to build or significantly refurbish the property. You calculate it by taking the stabilized net operating income.
Stabilized meaning, like once it's built and leased up and running normally.
Exactly. The expected NOI once it reaches normal operations.
Yeah.
You take that stabilized NOI and divide it by the total project, cost, land, construction, financing, everything.
So it helps answer. Is spending all this money to build or fix up this property actually going to give me a decent return once it's done and rented out?
That's precisely the question it helps answer. It's crucial for developers.
Okay, that makes sense. So we've covered profitability, investor returns. What about just the basic financial health and risk? Lenders must care a lot about that.
Oh, absolutely. And so should you as an investor. Two really critical metrics here are the debt service coverage ratio, DSCR, and the loan-to-value ratio, LTV.
DSCR and LTV. Definitely heard those from lenders. Why are they so vital?
Let's start with DSCR. The debt service coverage ratio measures the property's ability to cover its mortgage payments. Simple as that.
How is it calculated?
You take the net operating income, NOI, and divide it by the total annual debt service, that's all the principal and interest payments for the year.
Okay.
Lenders live and die by this number. It tells them how much cushion the property has to pay its mortgage. A DSCR of 1.0 means the NOI exactly equals the debt payments.
Cutting it pretty fine.
Very fine. Zero margin for error. That's why lenders almost always require a DSCR comfortably above 1.0, often 1.2, 1.25, or even higher depending on the property type and risk.
So that extra 0.2 or 0.25 is the safety buffer for vacancies or unexpected repairs.
Exactly. It's the property's financial breathing room after the mortgage is paid. A higher DSCR means lower risk for the lender and, frankly, more security for you too.
Got it. Higher DSCR, better financial health, lower risk. What about LTV?
Loan to value, or LTV, looks at how much debt you're using compared to the property's actual value. It's another key risk indicator.
So if the property's worth $1 million and the loan is $750,000, the LTV is 75%.
Correct. A higher LTV means you've borrowed more, so you have less of your own equity tied up, but it also generally means higher risk.
More leverage, more risk.
Typically, yes. If property values dip, a high LTV means you could end up owing more than the property is worth much quicker. Lenders use LTV to gauge risk and decide on loan terms, interest rates, loan amounts, etc.
Okay, so lower LTV is generally safer, more equity, less risky for everyone involved. Makes sense. All right, let's shift gears slightly. How do we measure how well the property is actually being run day to day? Operational stuff.
Good question. That's about operational efficiency. Two key metrics here are occupancy rates and the operating expense ratio, or OER.
Occupancy rate seems straightforward, just the percentage of space that's actually rented out.
Pretty much. It's the percentage of available units or square footage that currently has paying tenants. It's a direct measure of demand and how effectively the property is generating revenue. Higher occupancy usually means more stable cash flow.
Makes sense. And the OER, operating expense ratio.
The OER helps you judge how efficiently the property's costs are being managed. You calculate it by dividing the total operating expense. Remember, those are the costs included in the NOI calculation, like taxes, insurance, maintenance,
Right.
by the property's gross income.
So expenses divided by income, what does that tell you?
A lower OER generally means better cost control relative to the income being generated. It suggests the property is being run more efficiently. If you track OER over time, you can spot if costs are starting to balloon or identify areas where maybe you could save money and boost that bottom line, the NOI.
So if my OER is creeping up year after year, that's potentially a red flag about rising costs or maybe inefficient management.
Precisely. It warrants a closer look. Now, another related metric, especially useful after renovations or when a property gets fully leased up, is stabilized rent on cost.
Stabilized rent on cost, how's that different from yield on cost? They sound similar.
They're related but focus on slightly different things. Yield on cost, remember, compares the stabilized NOI to the total development cost. Stabilized rent on cost focuses specifically on the stabilized gross rental income relative to the total project cost.
Ah, okay. So it's looking at the income generation potential after everything settles down, post-renovation or lease up.
Exactly. It gives you that clearer picture of the long-term income efficiency once the property is operating smoothly after significant changes.
Okay, good distinction. So we've covered profitability, returns, risk, operations. What about the bigger picture? Market trends, future value. How do metrics help there?
That's where thinking about cap rates over time becomes really important. Specifically, comparing your going-in cap rate to your projected exit cap rate.
Going in versus exit cap rate. Explain that a bit more.
Sure. The going-in cap rate is simply the cap rate based on the NOI and price when you buy the property.
Okay, the starting point.
Right. The exit cap rate is your estimate of what the cap rate for similar properties will be in that market when you plan to sell it in the future.
Ah, so it involves forecasting market conditions.
It does. You're trying to anticipate if the market for that type of property is likely to get stronger, meaning cap rates might compress or go down, or weaker, meaning cap rates might expand or go up during your holding period.
And how does that affect my return?
Well, if you expect the exit cap rate to be lower than your going-in cap rate, that's generally good news. It suggests market values are rising, which means your property could be worth more when you sell, boosting your overall profit.
And if I expect the exit cap rate to be higher?
That signals potential headwinds. It could mean property values might stagnate or even decline, potentially eating into your returns when you sell. It forces you to think about market cycles.
Okay, that's a crucial perspective. And how do things like renovations or adding value play into this long-term view?
They play a huge role. By renovating units, adding amenities, improving energy efficiency, whatever it might be, you can often justify higher rents.
Which increases the NOI.
Exactly. Increasing the NOI directly improves the property's value. And if you've significantly improved